As you probably already know, I love investing in dividend stocks, but more importantly, I love investing in companies that generate strong amounts of free cash flow. In a lot of my videos, we typically look at a variety of different stocks at a high level, but today's video is going to be a little different in the fact that we're going to look at a single stock. We're going to take a little bit of a deeper dive into a stock that I believe is a must-own for any type of investor. This is a company that generates strong amounts of free cash flow. It pays a dividend every year, and it increases its dividend each and every year. So before we figure out which one stock this is, do me a huge favor. Click that like button down below. Subscribe to the channel so you're notified anytime we drop new content, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. So without further ado, let me tell you which one stock I believe is a must-own stock, regardless of whether you are a dividend investor or a growth investor. This particular company can appeal to both types from that standpoint. And when it comes to that one stock, that is going to be AbbVie Incorporated, stock ticker ABBV. And if you've watched any of my prior videos, you know the love I have for AbbVie. This is a company that was spun off originally announced in 2012 when it was spun off from Abbott Laboratories, stock ticker ABT. And since then, at the start of 2013, the company has been its own public company. As I mentioned at the start, AbbVie appeals to all different types of investors. If you like growth, AbbVie's got that. If you like high yield dividends, AbbVie's got that. If you love fast growing dividends, AbbVie has that as well. So let's first take a look at how AbbVie came about. For years, it was simply a segment of Abbott Labs, but in 2012, the company announced plans to spin off its pharmaceutical arm, which became AbbVie. At the time of the spinoff, AbbVie was a smaller company with a market cap less than Abbott, but over the years, AbbVie exploded with a market cap approaching double of Abbott Labs now, as AbbVie is nearing a $300 billion market cap at the time of this video. Over the past year, shares of AbbVie have climbed 16%, and over the past 5 years, shares of AbbVie are up 110%. However, when it comes to investing, especially for those of you that invest in dividend stocks, it's all about total return. Not just share price appreciation, but we have to include the dividend income that we're receiving as well. Looking at this chart here, you can see that AbbVie has returned an impressive 375% over the past 10 years. So at the beginning of the video, I told you that this stock will also appeal to growth investors. Let me show you what I'm talking about. When I show you the same 10-year chart that I just did, except now I'm going to include the likes of S&P 500 ETF like SPY to show you just how much AbbVie shares have outperformed the greater index over that period of time. Over the past decade, AbbVie shares in terms of total return up 375%, that of SPY up only 237%. Impressive outperformance. So what has led to the outperformance over the years? Well, for starters, the company developed and sold the #1 selling drug in the world, which was Humira. At one point in time, Humira accounted for over 60% of total company sales. However, knowing that Humira's patent expired at the start of 2023, the company has done a great job diversifying its product offerings. Looking at this chart, you can see how strong Humira sales growth was from 2011 through 2022. At its peak in 2022, sales for Humira reached $21.2 billion. However, as I mentioned, Humira had lost its U.S. patent protection at the start of 2023, so that was the first year that U.S. generics could come to market and revenues were expected to fall off. So what in the world is going to be able to replace sales output like that? Well, the company is already right on top of that, as they have two up-and-coming new blockbuster drugs in Skyrizi and Rinvoq, who are already growing at a very fast pace. Management expects the combination of these two drugs to far surpass the peak of the world's best-selling drug at one point in Humira. Both of these drugs already growing at an incredible pace, but still building up. By 2027, management expects that to be the year both Rinvoq and Skyrizi will combine for over $27 billion in company sales. So Rinvoq and Skyrizi have both come through the AbbVie pipeline, but the company is also going outside of its business to not only diversify its portfolio, but also grow its sales. Back just a few years ago, the company announced its acquisition of Allergan, a $60 billion price tag that would further help the company diversify its offerings. So by now, at this point in the video, you probably have a better understanding of what AbbVie does and its stock performance over the past decade or so. Now let's take a closer look at financial performance. And looking here, you can see how the company has seen its revenues explode all the way through 2022, and then the expected drop-off in 2023 and 2024 before the company expects to return to growth again in 2025. These are periods that all companies go through. It's that consolidation period. Even look at the likes of Apple. Over the past 3 years, net income has essentially gone nowhere. So that's looking at revenues. And for those of you that have worked with me through my 6-week Investing Accelerator course where we work one-on-one, we understand that while we like revenues, we like to look at more important things like operating income, operating margin. And if you're interested in taking my one-on-one 6-week Investing Accelerator course to learn more about how you can be your own portfolio manager, build out a strategy, an action plan, and learn how to value stocks the same exact way I do, check out the link down in the description below and book your free call, a free information call to see if you are a good fit for this program. So now let's take a look at how operating income has grown as compared to revenues over the past 12 months. As you can see, AbbVie has generated $13.6 billion in operating income. So companies are required to report revenues, operating income, net income, all the same exact way, just to keep all public companies in line with one another. So we don't have one company reporting things one way, another company reporting things one way. Nope, they all want to stay in what's called GAAP earnings, GAAP revenue, GAAP operating income, whatever it may be. However, companies also give you more important information, things that I pay closer attention to, which is called adjusted or net operating income, adjusted earnings per share, or non-GAAP, I should say. These things are companies trying to pull out things that might be one-off transactions that may not be a regular part of the business. Although they are required for GAAP earnings, the company's management team says, we are going to show you adjusted earnings as if we pulled that one transaction out entirely. This is one reason I technically usually focus more on non-GAAP or what's called adjusted earnings. Therefore, looking here, you can see the company's latest quarterly report. You can see that AbbVie reported adjusted operating margins of 42.2%, which is quite solid. Now let's take a look at free cash flow and look at this chart and how free cash flow has grown from less than $8 billion 10 years ago to more than $21 billion in the past 12 months, which is some impressive growth. Free cash flow is so important regardless of whether you're looking at a non-dividend paying stock or a dividend paying stock. But since AbbVie does pay a dividend, let's take a closer look at that dividend right now. We have seen the growth in the stock. We have seen the strong performance from the financial results, but all that and on top of it, you get a near 4% dividend yield just seems too good to be true, but it's certainly the case when it comes to AbbVie. A 3.7% dividend yield, a low payout ratio, and a 5-year dividend growth rate that has been closer to 10%, except for the past year when free cash flow payout, or I should say dividend payout, had dipped. But I fully expect that to pick back up in the coming years. And as you can see, the company has increased the dividend for a decade straight and counting. So by now you know a little bit more about the company. You've seen its strong stock performance. Now you've also seen its financial performance, how well it grows revenues, how well it turns that into operating income, and how well it grows its free cash flow over the past decade. But it's very important when it comes to investing to be able to separate. You can like a company, how well it's operating, how well it's growing things, but maybe valuation doesn't make sense. You can like a company, but not necessarily like a stock at today's valuation. And that's what we're going to look at right now to determine whether AbbVie looks cheap or expensive. Looking out over the next year, analysts are looking for AbbVie to generate EPS of $11.95 per share, with EPS growth picking up each of the next 3 years. That gives shares a forward PE ratio of 13.9 times, which is not all that different from where the stock has traded over the past decade, which is around 13.2 times. So as it looks now, based on this one metric alone, shares don't look all that intriguing. However, let me explain the intrigue when it comes to AbbVie, more for long-term investors. If you take a closer look at close competitors like Merck or Amgen or other large pharmaceutical companies, you'll see a very common path that AbbVie has taken. You start at a much lower multiple, but once you have a proven product and a proven pipeline, a strong management team, you have shown the ability to grow free cash flow, what you also see is investors are willing to pay higher multiples. You will see what's called multiple expansion over the year, where maybe you start with a 10 times multiple as your average earnings. Then it grows to 11, 12. If you look at Merck now, if you look at Amgen now, a decade back, they were trading closer to 12 times, which, as we just saw, is pretty close to where AbbVie is today. Now, if you look at Merck, now if you look at the likes of Amgen, you see them closer to a 15 times multiple, which is where the intrigue for AbbVie comes in. I believe that there's going to be multiple expansion with this company moving forward. So although shares don't look very cheap right now based on recent results, it's the long-term effects, the multiple expansion that we're looking for. Now let's take a look at what analysts think. Analysts are also upbeat on the stock, rating it a strong buy with an average 12-month price target of $186 per share, implying nearly 20% upside from current levels, not including that near 4% dividend you also get. So there we have it. We took a closer look at AbbVie, a stock that I believe and often referred to as an investor's trifecta. They offer you growth potential, they offer you a high dividend yield, and solid dividend growth. Number one, let me know what you think of this video down in the comments section below. Do you want more videos of this type? Also, let me know what are your thoughts of AbbVie and what do you consider a must-own stock for your portfolio? And if you haven't done so yet, make sure you smash that like button down below. Subscribe to the channel, and we'll see you in the next one. Take care.